So who's been winning from the subprime crisis? The fact is that whenever there's a shock in a market, whenever some people lose a whole load of money, by definition there must be somewhere else that's gained a lot, and that's certainly happened with subprime. So what actually did happen? With the subprime crisis, up to half of all the mortgages by some lenders were being lent to people with very poor credit histories, people who were allowed to make up estimates of their own future income and so on. What that did was inflate the amount of money that was in the housing market for loans. It put more people in the market able to buy. At the same time, interest rates were very low as 1% in terms of the Fed's own rate, and that meant that it was possible, at least it was justified by many of these banks, to see how people with a poor credit history and on low incomes could manage some of these mortgages. And for a moment, for that 2 or 3 year period when these loans were being sold, we saw a further acceleration in what Alan Greenspan had already called a frothy housing market, until it became what we would now regard as a classic speculative bubble. And when it burst, of course, some people lost but others gained. So what happened? The people who gained, of course, were people who were selling out, downsizing perhaps their properties, mainly people who were older, people who had saved up for retirement and had seen a lot of their equity tied up in the homes in which they were living. They sold out, went into their smaller retirement homes and made a big packet. Those that lost were on the whole younger people with poor credit history, people with very few financial reserves, who put what tiny reserves they had into their homes. And I'm not just talking about the capital that they used to buy, I'm talking about the money they used to then decorate or dig the garden or plant trees or buy new furnishings or put in new carpets or whatever. Those people lost a huge amount of money, but another group have also lost, and that is shareholders who had entrusted their wealth to banks, and the banks in turn had used that wealth, parts of it, to lend to the market, and those loans turned out to be really bad. Now, I know you could say it's not just that wealth, it was all kinds of other sources of finance that were used by banks, including their own deposits and things like that. But the fact of the matter is that that money was lent against security. The security was homes, and so long as the home prices were rising, then the banks were relatively okay. But with the recent loans, followed by spectacular falls in house prices, meant that the bank's own security was then in jeopardy, because not only was the deposit, if there had been one, of the borrower wiped, but also the fact is that if they were handed back the keys of that property, the bank would never be able to get back on the open market the full value of the mortgage they'd lent. Worse than that has been the situation where it's because so many banks have been trying to repossess at the same time, and then through a huge misguided judgment trying to flood all of those properties back onto the market to sell them at the same time. Of course, there's been no buyers around to go around. So that's meant that the property prices have been much more severely depressed and suddenly depressed than they would otherwise have been. What would be much more sensible would be to find ways to enable struggling and distressed house owners to stay in there for a little bit longer, partly because interest rates are coming down so rapidly that their repayments will become more modest anyway, partly because if they can provide, let's say, 25 to 30% per month of their normal mortgage repayments, it's better than nothing. And finally, partly because the banks themselves can then put off the evil day of having to repossess and sell